Lonsec wishes to remind that the information we provide on our portfolios is general advice, and we encourage investors to read the PDS or seek professional advice prior to making any decisions on their investments.
Hi, I'm Martin Graf, Financial Leadership. We specialise in helping retirees look after themselves and their investments and get up to retirement. Today, we're very fortunate to be sitting down with an expert from Lonsec, Dan Maradi, who looks after the investment side of things, particularly the direct shares, investments in the portfolio. We're going to get some expert and answers from Dan and the team to kind of talk about some topics from today.
Lately, I've noticed that the Australian market's been doing quite well compared to international markets like the Dow Jones, for example. Can you talk to us a bit about where you see the Australian market heading and why I guess it's performing better than its international competitors?
Yeah, sure. Look, you're right about that. Basically, I think that ties in with the other points of discussion in terms of the cyclical sectors doing better in this environment because of those dynamics of inflation and higher rates. Our market is dominated by financials and resources. That's almost 55% of the market. And they're the cyclical sectors that do well in this environment in terms of high inflation and commodity prices. So hence it's been risk on from an Aussie equities perspective. It's not common for Aussie equities to be outperforming, particularly over the last decade, because your US markets do have the higher allocation to technology. We don't have a high allocation to technology or those businesses in the Aussie market, whereas in the US, obviously you got the big four at the top there that have done really well. And that's the growth component of the market. So there's been a reallocation of funds to cyclical markets, and we've seen Japan rally, we've seen some parts of other cyclical markets in the market rally, and for Aussie markets to rally. So as long as this thematic is around in terms of rates going up, inflation coming in, I think the Aussie market should continue to do relatively better than global markets. Until there is some sort of a normalization or clarity in terms of what is the peak in interest rates and how long is inflation here for. So if the Reserve banks increase interest rates, inflation normalizes and settles down, behavior from a demand perspective gets back to normal, I think that will probably reverse course at that time.
It makes sense. So I guess that obviously, to summarise that very nicely, is that's the value of diversification. Is international stuff, and Nasdaq has done very well for the 5+ years, but doesn't mean it's always going to. So if we look in the revision mirror, it might not always be the best indicator of what's going up.
It is, and that's the whole part of the process in terms of we make sure that we've got embedded diversification at a security level and an asset class level, because you don't want to time these rotations or these swings in the market or speculate on how high interest rates are going to go or where inflation will go, because that's not our core strength, and even the experts can't get it right. So it's to combat that, what we need is diversification. Like we've had gold in the portfolio, and at the times the market goes well, gold doesn't do anything, and we don't expect it to. And we've seen this year gold be one of the best performers in the market because inflation, currency, geopolitical issues is a positive for gold. And we've felt that over the last couple of years, we need an element of that in the portfolio. And same with cyclicals and growth, they're not both going to outperform or perform well at the same time. But we've got to make sure over the long term, we want to have diversification at that level to make sure that we can gravitate towards it. And if we get higher conviction on those themes like we have now in terms of what's happening, we can adjust the portfolio if necessary.